Hello, followers of the 4-Year Journey. I hope you're doing well. This is Bob Lucas here on December the 15th, 2021. Essentially 3 years, almost to the day, on the anniversary of the last 4-year cycle ending and the beginning of this current 4-year cycle. Firstly, I want to apologize. Really feeling under the weather this week, not feeling up to a long, detailed video. And also, I'm looking to take my annual break here at the end of the year and go offline for a couple of weeks. So I thought better to get something out than nothing. It's been a couple of months since the last video. So this will be a pretty short video in general, and I'm not going to get into too much depth. To be perfectly honest, nothing substantial has changed in my outlook overall. There are some areas where there's possibly some concern, but as an active hodler, as somebody who's looking to capitalize over a very long time period, most of that really falls under the category of noise and playing to somebody's fears and reading into charts where maybe they're just impatient or concerned with where they stand currently with their positions. So let's go into a couple of some ideas here that I have regarding this current 4-year cycle. Of course, beginning with just where we stand in the cycle. So from a monthly, let's go to a monthly. From a monthly perspective, here we are 3 years ago, December of 2018. We finally bottomed out after a 1-year decline, almost to the peak. 4 years ago, the peak in December of 17, and 3 years ago, the bottom. So it was a perfect 1-year bear market that really set the scene for this current 4-year cycle. The next 4-year cycle low is due here at the end of 2022. So basically a year from now, give or take a couple of months on either end of that cycles. That's an average. Of course, they can go by a good 10% on either side of an expected cycle low. This is the only point in my analysis that really matters the most. And I think people always get hung up on where the top is going to be and where it falls. And if it doesn't fall exactly or near where somebody may expect it, or where I expected maybe 2 or 3 years ago, they begin to lose confidence in general with their overall positioning and their overall thesis. The top in a cycle can occur almost anywhere, and it depends mostly on the longer term trend. So when you have a longer term uptrend like we have here for Bitcoin over the 10 years, a secular bull market uptrend, typically you'll find the top will occur much, much closer to the next low. And that allows for a lot of time in a rising portion. So in a powerful secular bull market uptrend, the top in the 4-year cycle is going to likely occur around three years in, maybe even deeper into the 4-year cycle. And when I began this series, again, 3 years ago, the first video I believe was recorded on December the 8th, 2018. I essentially said around the 3-year mark, around exactly where we are today, that's typically where we should at least expect the area for the top in the bull market. And it hasn't come as of yet. It looks as if that top in this bull market is now pushed into 2022 and looking like Q1 is probably not even enough time. Maybe it's Q2. And that's perfectly fine from a cycle perspective. It's really the low, again, that's going to matter. But what it does do is the longer or the deeper we push into the cycle, then the shorter, in theory, the duration of the next real bear market will be. Although, that's also somewhat insignificant. We've had already a number of 50% or 45% or more retracements within this rising portion of the 4-year cycle. The volatility is just there in Bitcoin, and I feel generally based on comments and what I read out there that most people still haven't fully embraced the volatility profile that we see in Bitcoin, and we have seen really since inception. When you have an asset class that has the ability to triple and quadruple in just a few months' time, as you can see in 2017, back in 13, even to start this 4-year cycle. And of course, a year ago with that run from 10,000 to 60,000, anything that has the ability or the profile of being able to make a move like that also comes with, to the downside, tremendous amount of downside risk and possibility at any given time. And again, if you can't embrace that in your positioning, and that's why I always say your position size matters in an asset class with this type of volatility. If you can't hold your position through the swings and through that volatility, then you're not going to be able to get to the end of the cycle and realize those gains. And I mentioned that almost in every single video since the inception. And I've always talked about the prize in this cycle being in this sort of quadrant up in this area around this time period, granted, and much higher than where we are today. And that leads to the next sort of natural question: are we going to get there? Because when I asked on Twitter, I think it was on Monday or earlier, late last week, do you have any questions for the next video? What's the type of question you'd like me to address? And it really was interesting that the vast majority of the questions that were asked were essentially, have we topped? Was it a double topped? This is a bear market. A lot of them were just pure statements that this was a bear market. How low can it go? All of the very negative elements and all the very negative questions, and almost very, very few questions on how high can we go? How far are we going to go on the upside? So sentiment is very important in cycles, and I've noticed a tremendous shift in sentiment. Almost really not as bearish, but really just as bearish as it was in March 2020 when it recovered, and certainly getting close to the sentiment levels that we had seen in the bull market period, the bear market period of 2018. So from a contrarian sort of standpoint, I like that. That's sort of music to my ears. Bull markets end obviously with a lot of euphoria, and sentiment is wild to the bullish to the bull side, and we have nothing like that. And one can make the argument that we had something close to that in this November through to sort of March run back earlier in the year. But at the same time, I don't feel that it was a type of sentiment, the type of retail participation that I would expect to see from an asset class that's maturing like it is. It certainly wasn't anything like the 2017 move in terms of sentiment, in terms of new retail participation. Very little of that occurring right here. In fact, yes, we had some retail participation, new retail participation at the end of this move the last couple of months. I had some acquaintances or friends of friends who sort of got involved at this point. But again, nothing close to the type of extent that you had seen in the past. And I think more importantly, nothing that it comes close to the type of mania that I think we want to see or expect to see in a bull market with a market cap much higher, with much broader participation. So that is one of the main drivers for me thinking that we didn't see a top in this 4-year cycle, that we still have further action to go. And also, not that I'm a big on-chain analyst, but I do look at some of that data. And some of that data is really healthy from an accumulation and a hodl standpoint, from what the miners are doing in general. It just feels to me as if we're just building yet another base right here that will support the final run to the 4-year cycle peak. If I look at it from a weekly chart, sort of break down a little further, it looks a little similar in structure, at least, to kind of what we had here in 2019 before the eventual run up to this peak. It's almost as if and I did talk about this being a foundation back here when it was developing, and that was the catalyst, or at least the springboard, to allow it to make that big run up. And this 4-year cycle seems to have a lot of that characteristic. If you remember or recall back when the bear market ended, very few people were expecting this to continue. Bitcoin was dead at that point. And then Bitcoin, within space of 6 to 10 weeks, went on a 4x run. that very few people were able to capitalize on and to take advantage of. And it wasn't until it broke above this 10,000 level and spent just a couple of weeks going to 14,000 did everybody who was in the past bull market involved finally sort of wake up and say, geez, this really is back on. This is over. The bear market's done. We're back in. And of course, just like markets like to do, they like to punish the undisciplined investor or trader who comes late to any move and who follows essentially the herd. And, that led to a pretty savage 9-month decline that also culminated after trapping people in with this move right here with one of the most historic collapses in Bitcoin's history. And that set and sowed the seeds for building this foundation. Of course, again, I said this was not the 4-year cycle top already. This was a place to get back in. And eventually we made that run up. And I think, again, this 4-year cycle has really just shown us 2 major runs, and the rest of the time it's been a lot of shakeouts, a lot of sort of back and forth grinding action that's been frustrating for a lot of people. The only people that I think have done extremely well out of this cycle, of course, there are always many individual cases, but the people that have done best are people who are following sort of strategies like this, where you're looking at a much wider, much longer time frame, and you're believing in the underlying philosophy, the underlying technology, and you're in with a reasonable position, and you're not allowing the 50-60% declines, the shakeouts, the collapses to shake you out of that position, because you have a longer term strategy in mind, a longer term target in mind based on time and also price, and that's allowing you to stay in position. But now we stand 3 years into the cycle, and I feel that position, that belief is wavering, and people are really questioning that narrative. And that's because, for the most part, if you follow that strategy, you're sitting on a really sizable, profitable gain, at least on paper, if you look at your Bitcoin stack from a USD or a fiat perspective. Of course, the folks, and there are some who are listening, view their portfolio as 1 Bitcoin equals 1 Bitcoin, and it doesn't really matter. And for them, that's fine. They are true hodlers in that sense, and it doesn't matter. And they're in for the very, very long term, regardless of any 4-year cycle decline, let alone these intermediate declines. But for the active hodler, for those who sort of want to get in on a longer time frame at a low price and at least capture some of those gains and maybe buy a nice piece of property or shore up their financial future, it's important to them. And I think that's playing on a lot of people's minds right now, where they look at this market and they look at the paper gain that they have, and they're worried that they're going to get caught in a massive bear market 85-90% decline again. And I will say that I do believe that we are eventually, in the next bear market, going to see 80% declines again. I don't think that's personally going away, given Bitcoin's volatility and its profile and its history. I don't buy any narrative that institutions will never allow that, because we've already seen 50% declines and so on in short periods of time, and even, of course, the March collapse. So I don't buy that narrative. So yes, I do believe we will see large multi-month bear market declines of 80% or more, but I don't think we're going to see that now. And that's why people are very worried that they may have seen the top right here, and they begin to read a lot into the charts. Now, yes, until we get back above the highs and break this sort of double top structure, okay, anything is possible. And I'm the first to admit, and the reason why I'd sold a small piece of my allocation at 28%, I just wanted to bank some of those gains and allow me to be in a position right now where I can be a little more patient and not freak out over the slightest kind of action that doesn't go perfectly to plan. Plans are there as a guide, and one that you need to believe in, but also be flexible to adjust when that plan doesn't go to accordingly to the analysis. However, right here, I still don't see anything that ultimately scares me. I know a lot of people, I mean, if you recall with this decline here, just 3 or 4 months back, maybe a couple of videos back, the calls for a bear market were loud and deafening, and it didn't happen. And so many people sold right in the bottom right here. And even when it sort of surged right here, the talk that this was just an impulse move, and all the bear market comparisons to 2018 and other bear markets were all over social media. And then it really quietened down when it got back up to the highs. But conveniently, like all markets like to do and confuse, we've now got this sort of double top structure that bears are latching onto, and that's the narrative. And that's either full-on sort of perma bears or just folks in general who want to believe in a bullish case but are just so concerned with losing what they have that they latch on to this bearish narrative. From a cycle standpoint, when I look at these 60-day cycles, I still see in the short term a rising structure. The last 2 cycles, the lows have formed above the prior low and the high above the prior high. So at least in the intermediate time frame right here, we're in a rising structure. And more recently, just 4 or 5 weeks ago, even though, yes, it looks like a double top, we still had an all-time high, even on a closing basis. On a closing basis, we even exceeded the wick from back here in April. So I don't see a reason for panic. The only thing that sort of concerns is the fact that we didn't see a blow-off top sooner. But again, every cycle is different, whether it's on a 60-day cycle or a 1-year cycle or a 4-year cycle. Every cycle is different. And when you're so fixated on like the prior cycle, for example, that did something like when it broke all-time highs, went on a straight run to the top, when you're fixated on the market having to perform in a very similar way, then when it doesn't, you begin to assume the worst in general. And I think a lot of people are doing that right now. So for me, just to keep this really as tight and as short as possible from an analysis standpoint, until we get below the September lows, which is around the $40,000 level, I don't get worried, okay? If we get below that level, and I mean close at that level, if we close below the 40,000 level, I begin to get worried and I begin to hedge my position. So, I'll give you an example. I don't want to give any advice here, but if I had a retirement account that is not that's tax advantaged or does not have any tax reporting issues, I may sell my spot right there and buy it back if we recover that area. Okay, so there's more flexibility in that. And in something like a leveraged account or a trading account, or even a spot account that is subject to sort of tax considerations, there are other options to hedge that position, whereas it could be a short position in a futures market, as an example. My point being here is that below 40,000, I begin to get a little concerned. I get concerned that we have some type of double top structure, that was the mania peak, call it if it can qualify as a mania peak, but it was the peak of the cycle, and this was just sort of a retest of that level before rolling over. And then I would have to be prepared for a 1-year bear market to follow that point. And that bear market may not necessarily be a massive move lower. It could be a significant sort of punishing sideways move. I mean, we had something similar to this where we peaked in June and we didn't really recover, didn't really break out again and make a new high for well over a year. And in the middle of that, there was a bear market decline or a significant decline to a bottom. The path forward, there are multiple paths forwards in that case. But again, while this structure holds up, and it's certainly while this $30,000 level, I think that's a very, very important level coming off this 50% decline. If that level there at the $30,000 level was to be lost, then I would certainly be out of all my positions. I mean, I'll keep always some small position that sort of transcends the 4-year cycles in general. But I would think below the $30,000 level from a closing standpoint, let's just call it on the weekly, then there's serious trouble for this market, and the price action would then tell me that we're on our way lower. And then the downside targets, because this was a question so many people asked, so I'm going to throw it out there. The downside targets really open up to almost anything you can imagine. And call me crazy, but the downside targets really go down as far as, like I said, from a peak to trough perspective, going down 85%, is a possibility. Going down to the $10,000 level would mirror the types of declines we've seen in prior 4-year cycles. Now, we only saw a 3 to 4x extension from the prior highs in 2017. So an argument could be made in the bear market that if we topped in this area, that because we didn't see the type of extension to the bull side or the peak, that the bear extension down may not be as bad. But certainly looking down to this 19 or peak back in 2017 would be a target. Again, careful with the words I use, if we were topping for whatever reason in this area. Not my belief for a second, to be perfectly honest. If the price action tells me otherwise, then I'll be quick to do that. And, hedging and selling at the 40,000 level and then ultimately out the $30,000 level. Is it the end of the world? It's not for me, at least. I don't think it is for anybody who's been actively following the process and essentially taking almost a 10x gain in the spot in any investment is phenomenal, especially if that were to be the case, considering that we only got a 3 or 4x extension when everybody's been expecting a 10x extension to 200,000 and above, and especially considering the vast and the significant volatility that we saw throughout this 4-year cycle. To be able to walk out at a worst case scenario with a 10x gain over that period, given all of that, I think is a good result. Now, that's putting aside now all the bearish talk, all the negative talk. Let's get a little more positive. So from a 4-year cycle standpoint, using 60-day cycles here as a guide, I think we're probably now looking at a sideways chop into the next 60-day cycle low into the February timeframe. And what I'm looking for is sort of to build this right side here a little bit more and just really be range bound from, let's call it sort of maybe down as 40 to low as 40,000 to 60,000 for one more cycle before testing those all-time highs again and breaking out. Now, if that were to happen and follow that path, what I do believe you'll see with the eventual break of that level is you'll see that final shot up, and it would be quick and fast and possibly just 2 60-day cycles and no more than that. So over a 120-day, 4-month period. We've seen that before with the type of move that we saw back here in March of 2019. And of course, we saw that with October move. These were sort of 3 to 5 month moves. And I certainly believe, given the 4-year cycle timing, the fact that the next 4-year cycle low is due 1 year away, I do believe that eventually, when we do break to the upside, it's going to be a fast move and most people will miss it again and also start to get in at a price around 70, 80, and 90,000 and leave themselves very little room to a top. And that's because if we do get that run, all the super cycle narratives and all the up-only narratives will come back in force, sucking all of the participation in to the top to provide liquidity for that market for the top and their eventual reversal down. To me, again, looking at the monthly, we're sitting at the 10-month moving average right now. The 10-month moving average for a trend is important to me. I like to see any bull market uptrend respect that 10-month or a 10 EMA. In this case, the 10-month moving average. We're right at that point, slightly below that level right now. So here's where I'm saying we need to build this base and hold this kind of level right here. And that's why losing those lows from back in June really tells me that the trend is done. At that point, it's too late in the cycle. You can get away with it early in the cycle like we did here in March. And certainly because we did stretch too far to one side and then the pendulum swung back the other way. This time we're 3 years into the 4-year cycle and we should be getting into that really speculative blow-off phase of the cycle. I don't see a market that can support on the monthly getting below that $30,000 level and then reversing and coming up to a high. Just not enough time as far as I'm concerned for that to play out. So this is why I'm saying here, we need to hold this level. We can make a move down to 40. We can even possibly wick down to 30 in a sharp fashion and end up with a wick similar to the March 2020 wick. In the end, though, by February, I'm looking for this move to come back up to test those highs. And then, as I said, 2 cycles, maybe no more than 2 cycles, I would think, into the summer months now, looking for that peak, then a bear market decline. And then let me I've talked about this before. I think we can then follow that up with a relatively quick bear market decline into the 4-year cycle low, sharper in nature than anything else, that follows a V-shaped recovery to make one final run to the peak of the next cycle. And this would be the next 4-year cycle peaking early. So this is not anything like the idea of an extended cycle. The 4-year cycle lows would still remain consistent. It's the peak in the cycle that I introduced this video with that can come at any point in the cycle. And what I believe is, from a longer term standpoint, we're going to begin to see a more of a rounding pattern as we begin to reach those higher market cap levels and start to reach a general maturity level for an asset class. I believe then this blow off move sets the scene for not so much an uglier bear market, but more of a bear market similar to the NASDAQ of 2000 to 2003 period, where after a massive blow off, we had a really long consolidating period. And I think this is what this market is setting up for. Now, of course, there's no point in talking about the next 4-year cycle when we're still trying to figure out this 4-year cycle and work out whether or not we still have that blow off move for this 4-year cycle. So let's just put that aside, and it doesn't really change or should not change your behaviors in terms of allocations at all. So for this 4-year cycle, just moving back to that, I still believe, again, just to really summarize this video and close it out, that we are heading up to this move right here, that getting below 30 is an ultimate get out position or get out signal. Getting below 40 is probably an area where you would want to sort of hedge. I can't describe what that looks like, how that's executed from your behalf. That's something you would have to do, or whether you should even bother or care at this point. I think ultimately that $30,000 level is the most important level, and losing that level is lights out for this bull market 4-year cycle run. Otherwise, I just would say lean back on some of the other videos and focus on your mental state and your psychology. If you can't hold this big profitable position and this is spooking you out, I've said this before, release some of it. Take some gains. Bitcoin's at $47,000. Don't look at it and say, well, it was at 64,000 not long ago. I'm giving up so much gains. Look at it like, well, I got in at 4, 5, 8, 14, whatever the number is, and it's now at 45. That's great. So I'd only recommend that for folks who are just struggling in general with their position size, who are waking up daily and nightly, looking at price and really freaking out about whether or not this market has topped. If you're in that position, you're probably just way too vested. You've got too much in the line. You're risking too much. So don't let the market force you out of position at that point, especially if we get a move down to say, 35,000 and not invalidate this monthly chart. If you're going to puke that position because you get scared for another $10,000 drop, then just start to take a little bit of profit. It's not the end of the world if it can support the market, if it can support you running up in the next 4-year cycle and keep your position, then that's ultimately what you should be doing. So I'm hoping this has helped. Again, I've done 13, 15 videos over this 4-year cycle. The message is the same. It's repetitive. It really is more about how you approach the market and the discipline that you put into this that is ultimately going to be the determining factor in your success. Looking at charts all day, if you look at a chart long enough and you have some preconceived bias coming into it, then you're going to find what you want to see and what your bias is telling you should be seeing, as opposed to just respecting the trend, respecting the cycle. At the moment, we sit at the 10-month moving average that's rising. Respect that for now, and again, adapt when that changes and the facts change, and they haven't changed just as of yet. Markets aren't supposed to be easy. Trading or holding Bitcoin essentially has never been easy. So respect that and know that that's the case, and I think you'll do well in the end. Ultimately, whatever the result from this 4-year cycle, you should do well, and you should be in a position to do well regardless. The question is just how well in the end. Thank you very much. I'll have another video out in about 2 months. All the best.